Hi, good day, my viewers. My name is Kingsley Uten. I'll be taking you through a presentation I made on Power BI, showing us how Power BI could be a very powerful tool in generating insight for decision making. In this video, we'll be looking at how we can use Power BI to generate insights on the profitability of a business. Now, this data is from a company that operates in the hospitality industry, rendering services including rooming, restaurant, bar, and laundry services. We would look at the return on capital employed, cash return on assets, asset turnover ratio, the gross profit and net profits margin, owner's drawing, and the return on capital employed and the cash operating cycle of the business. Starting off with return on capital employed. This return on capital employed shows how well the company has been able to make returns on the money it had invested or the capital it had employed. The return is measured as the profit before interest and tax, while the capital employed is measured as the equity of the business plus long-term debts incurred in financing the business. What is the ideal situation? Looking up the hospitality industry in Nigeria, the average return on capital employed is about 20%. Now, coming to our data, looking through the whole period, they have not been able to meet the industry average, clearly showing that the business is behind in the industry. What is the trend in the data of return on capital employed? Starting off in 2019, we see the business making a 10.96% return on capital employed, but then gradually declines into 2020 quarter 2, and then by 2020 quarter 3 it peaked and was stable for a while at about 9.03% up until the first quarter of 2021, after which it experienced a gradual decline and then experienced its all-time low in the first quarter of 2022, when it recorded a loss, resulting in a negative return on capital employed. Although it picked up, but still very insignificant, and went down again by the end of the third quarter of 2022, experiencing also a negative return on capital employed. What does this indicate for the business? It simply means that the business is not generating enough return on the money that has been employed in running or setting up this business. Yes, it is true that it is generating some returns, at least above 10%, but is this 10% satisfying? Is this what the shareholder wants? Well, compared to the industry average of 20%, for the past 3 to 4 years, from 2019 down to 2022, the third quarter, you clearly see that the business is not meeting up the industry standard or the industry average, clearly pointing out to the fact that more should be done. The company should look for ways to ensure that it grows its return, to increase its profit before interest and tax. This way, it will be able to improve its return on capital employed. Next, we look at the cash return on assets. Cash return on assets measures how well the entity has been able to generate cash using its assets. Cash is measured as the operating cash flow, and then assets measured as the total assets the ideal situation in the industry really is not known. There's no public data available for that. But then, what does the trend show? We see in the first year, from the fourth quarter of 2019, it was negative, meaning that enough cash could not be generated in the first year. That's the last quarter of the first year, 2019. But then gradually in 2021 first quarter, it peaked to 4%, declined in second quarter, and then peaked again. Was fairly stable, revolving at around 7 to 8% during this period, and then the fluctuation continued from the third quarter of 2022 down to the third quarter of 2021, a complete year, and then there was a decline in the first quarter of 2022. Remember, we also had a decline. So this loss that was made in 2022, resulting in a decline in return on capital employed, also resulted in the decline of cash return, and it picked up and went down again. So what does this mean? What does this tell about the health and efficiency as well as liquidity of the business? Well, the business is generating very little cash, indicating that it may not have cash to meet up some very large expenses or sudden expenses that may come up in the future. So the business really needs to work hard in improving its cash generation using its assets. In terms of the health of the business, it indicates the same thing as the return on capital employed does, showing that clearly the business is not generating enough profit, is not making enough from its operations. It therefore needs to work hard. The managers needs to work hard to improve this position. Now looking at the asset turnover ratio, what does this ratio tell? The asset turnover ratio tells us how well the business has been using its assets in generating sales. So the measurement is the total sales or revenue generated divided by the total assets of the entity. What can we tell from the trend in the data? Well, we saw that in the first year, the business was able to generate 22.74% asset turnover, meaning that it was able to generate up to 22.74% of its total assets as cash. Yes, and we saw these calculations, this figure decline gradually from the fourth quarter of 2019 down to the second quarter of 2022. The same way we're experiencing this decline, clearly pointing out that the second quarter of 2022 is not really a fine time in the history of the business. Maybe because the business was still young, or it experienced a very significant event that would need to be looked into. But then after that period, we see an increase to 26.26% in the third quarter of 2022, and this remained fairly stable until the first quarter of 2022. Remained stable around 26 to 24%, so lifting, and then after the first quarter of 2022, we saw a significant rise in the second quarter of 2022, but then a decline in the third, clearly showing that the business had been able to maintain a stable level of income after stabilizing. It was able to stabilize its income compared to the total assets. or as a percentage of the total asset it had. It even grew it significantly, but then it declined. But a word of caution is to note that this quarter 3 of 2022 is just for just 2 months in that quarter, not for the 3 months. So really deciding based on that data would be a little bit, unfair. But the fact still remains that the business was able to do significantly well in the way it has generated revenue using its assets. But then, if we see stability here in its revenue, but then, we also saw a form of stability in the way it has generated cash, clearly pointing out or resulting from the stability in the way it has generated revenue. But then we saw a decline. Why is this so? Clearly showing that we need to look into the capital or working capital management of this entity. We'll dig deeper into this in the next video, but for now, we see that in terms of revenue generation using its assets, the business had tried, so to speak, but so much they could do was at 36%, still below the industry average for that ratio, the assets turnover ratio. So looking at the gross profits and a net profit margin, the comparison of both, we see that in the first year, or for the gross profits, the business was able to maintain a steady increase in the naira value of its gross profits. We see from the first year it was able to steadily grow this figure, but then looking at the margin of this profit, it has increased compared to sales. We see that it has been steadily maintained around 79 to 85%. It is always around that figure, clearly pointing out to the fact that the managers of the business have been able to carefully manage its cost of sales so as to allow the gross profit margin to be fairly stable around 79 to 85% of the total revenue generated. But what can be said about net profit? As we can see, net profit on the other hand experienced a decline, a steady and gradual decline. And this decline started off from in terms of the margin, from 48% of its total revenue, and continued to go down from 48, going down 39, 30, 27, and even a deep 20%, minus 20%, 17%, and down like that, clearly showing that even though it had increased its revenue and was able to maintain a fairly stable gross margin, that means a fair proportion of its revenue has been sunk into cost of sales. At the end of the period, it has continued to generate lesser and lesser net profits. Why? Because it has expended too much in terms of other admin and operating costs. Looking back, you notice that gradually operating margin that was at 48% gradually continues to grow to 50, 54%, 61, comes down again to 46, was stable around 40 for a while, increased to 50, 50%, stable, increased to an all-time highest of 103%, meaning they spent all the income they generated in the first quarter of 2021 on admin and operating expenses, and even spent more. We see another spending over 50% on admin and operating expenses again in the second quarter of 2022, and we also see an 83% spent on admin and operating costs. What does this mean for the health and efficiency of the business? It means the business needs to pay serious attention to its operating and admin costs. Yes, a red flag should be placed on spending for operating and admin costs, so that it will not end up spending the whole revenue it had made on admin and operating expenses. That would not be good for the business. Now let's take a look at owner's drawing, and let's see how this would affect the profitability of the business. What this actually measures is how much and the rate at which the owners of the business are withdrawing or taking away from the business. Mind you, the data is of a partnership business, so that explains the need to check the owner's drawing so as to checkmate the health of the business. Now, looking into this image, we saw that starting off, the owner's finance drawing was around 108,000 and was, very low, so to speak, but not very low, because compared to the amount of revenue or cash it is generating, the amount of net profits which we've experienced in the past, that always low in terms of its proportion. The owners are taking out money for personal and other non-business use. Clearly, that is not a good sign, and it has always been, though sometimes in the hundreds of thousands, but we see 2 million taking out, 1.2, and then the highest of all, 10 million withdrawn from the business. What does this tell us about the owners of the business? Clearly, they really are not interested in the health of the business. Why do we say so? You see your business suffering and trying to gain food starting off, and then you are taking out a huge sum of money as this. So the owners of the business should be careful, should be cautious of how they take out funds from their business, because this could seriously hinder the growth potential of the business. So this should be properly attended to. Next, we want to look at the return on capital employed, comparing it with the cash operating cycle of the business. Why is this comparison necessary? It is necessary because it's an established fact in finance that as the cash operating cycle, the number of days of the cash operating cycle increases, the return on capital employed or the profitability in general of the business will drop. Now, this is one way to check the cost. What could be the cost in terms of the working capital, how it is affecting the profitability of the business. Notice that we mentioned earlier about the return on capital employed, that although it declined because the business is starting on. When it peaked, it was fairly stable for some time and then gradually experienced decline and even had a sharp dip, a negative return, showing that cash return on capital employed is reducing. Now, how is this reduction or decline rather in return on capital employed being affected by the cash operating cycle? We noticed that when it started and when it was stable, all this while it's had very low cash operating cycle of less than 60 days, with 60 days being the maximum. But then as return on capital employed, as cash operating cycle gradually increased, we now started seeing a decline. The more it increased, the more decline we saw. Maybe along the line, the business owners were able to manage the activities very well and started to reduce the number of days. Now reducing this number of days had a positive impact in that return on capital once again came up. But then when the days of cash operating cycle started shooting up again, what do we see? We see the business starts to experience a decline in its return on capital employed, clearly showing the fact of what has been said about the relationship between cash operating cycle and the profitability of business. So we can rightly conclude that the management has not really been efficient in the way it has managed the cash position of the business, its cash cycle. How it has managed that is not really encouraging, and that has resulted in the continuous decline over the years, even with the fact that the company has been able to generate steady amount of revenue as a proportion of its assets invested. Although low, but then it is able to generate that amount steadily, that proportion on a steady note. But then the returns are declining, profitability is declining, showing there's a problem. So the management needs to look carefully at its cash management policies so as to see ways to improve the position. And by cash management policies, we mean their policy in relation to inventory management, policy in relation to receivables and accounts payable. Yes, when they look into this, they can see how they can improve that, and in the long run improve their returns as well as their profits margin. And also another thing we also saw is how it has not been able to carefully manage its admin and operating expenses. So carefully, the management should also look into this. So, insightful, not so. This has indeed been a very, very, very interesting video to see how Power BI is helping thousands of companies generate insights. So, would you like to learn more? Watch out for more video, as in the next video we will see how Power BI can be used to analyze this time the working capital management of the entity in terms of its cash operating cycle, and then what insights we can gain about what the problem exactly is and how solving those problems can solve the profitability issues of the company. Would you like to get actionable insights from your data to grow your business? Power BI can help you do that. And I still remain your Power BI guy, Mr. K. reach out to me via email, by call. To learn more on how Power BI can contribute to helping you grow your business, you could visit my website or see my LinkedIn profile for more ways that Power BI can help grow your business.